Hey there, good afternoon or evening, depending on what time zone you're in. No, most of the stuff we do is in the Northwest. Hi, my name is Joe Joner. I am a first-time homebuyer education provider, I guess if you want to call it that. I am state certified with the Washington State Housing Finance Commission, so I'm a sponsored lender. But I want to make sure that everyone who's tuning in knows that this is not that class. You need to attend a 5 hour class in person, which there are a ton of them if you log on to their website. We provide them as well, all the way from Clark County down in Vancouver, Washington, all the way up to where I spend most of my time up here in Snohomish County, which is just outside of Seattle, north, like in the Linwood area. That's where my primary corporate office is. Again, thank you for tuning in. I do want to say a quick thanks to some of my realtors who are on here, Kevin Tooley, Titanium Real Estate, Jim Best, and Lynn Lawrence as well up here in Seattle, Alan Orozco. I just want to say thanks, you guys, for tuning in, taking the time to do this with me so that we can take some notes and try to improve this as well, because I do teach homebuyers classes with most of those folks. So anyway, let's just dive right in. Okay. Oh, sorry. That is one of the other class instructors. That's Jim Best down in Clark County. Just to let you know, we've got a lot of experience. I've been in this business for over 22 years. 22 years. I'm with Bank 34. I'm originating partner with the Builder Affinity team. I've got 3 children. I've been married over 17 years. I do love sports. Those of you that know me, or if you get a chance to attend in person, I do talk about sports and try to reference that just because I am a sports freak, and I have been a season ticket holder to many things, including Seahawks football, Husky basketball, and Husky football, and a longtime Blazer season ticket holder as well. So that's been a little rough over the last few years. But anyway, I volunteer a ton, especially up here in Snohomish County, where I spend most of the time, including planning commission. So that helps me, I guess, venture through the politics of getting things through the permitting process and approved. But at any rate, I enjoy those things, and I just like being part of the communities. I'm also heavily involved in the school district. I'm a big supporter of that time, money, energy, and effort. I did buy my first condo using 2 credit cards. And if you ever attend my class, I'll tell you how I did that. It's just kind of a funny story. I like to share a lot of personal things when we are in those classes. At any rate, let's keep it moving along. I did silence everyone, so those of you that are on here, again, thank you for your patience. We're going to hold all questions till the end. And again, you will all get my email and contact information. So any questions, comments, concerns, you can email those directly to myself, and either me or my assistant will get to you right away. Okay, thanks again. Let's move it along. So these are things to think about. This is just kind of to get your brain ready, I guess, for learning, as they would say. And I do this all the time in our Seattle area. Does anyone know what the home ownership rates in the U.S. are? Funny thing is, you can't chime in because I've muted you. So I'm just going to go ahead and give you the answer. It's 62.9%, which is down from the all-time high in 69.2% back in 2004. Now, those of you that have been around or were looking at the housing market even in 2004, you will know why we were at an all-time high. That's because of the crisis where we approved everyone, and I'm not kidding. Anyone with a pulse could get a loan. And that's part of the problem back in the day. So let me move myself over here a little bit. I think I'm blocking. There we go. Again, this is part of my Seattle PowerPoint, I guess. So if anyone knows what the Seattle Comprehensive Plan for Growth Strategies are, again, you cannot chime in, so let me just give you the answer. Seattle is anticipating at least 70,000 housing units, and what that means from 2015 to 2035, growth. So we're going to have a lot of growth, and that's directly from Seattle Office of Planning and Community Development. These are not statistics that you can't find. You can look all this stuff up. I'm just trying to tell you, my point is, we're going to keep building housing as long as we can find land or keep going vertical, right? So I would think it would behoove you to try to get in the game. I try to tell people that all the time. You've got to be a homeowner. You've got to play a monopoly, and you've got to get on the board. How much of your monthly income should be allocated for your mortgage payment? That's a tricky question, in my opinion. Again, you cannot chime in, so I will give you the answer. This is a really generic answer. It's typically about a third. And again, you can look from Dave Ramsey to Forbes magazine to all the literature and books out there indicating what you should participate at with your income. And a third is kind of where they all sit. Now, what we can do, and this is, goes to bond programs and other programs that we have internally at the bank as well, is that we will typically go up to 40, 45, or 50%. Now, that doesn't mean you should do that. It just means that it's available. So if you have a higher threshold or a higher income, 50% may not be that big a deal to you because you have a little bit more residually left over. For those of you making less money, 50% of your leftover money may not be enough. So that's why I say it's just a gauge out there. Okay. And again, that'll indicate what your debt ratio is, and we'll discuss what that means as we get on down the line. So does anyone know the difference between your front end and your back end? Now, I'm not talking about your derriere. I'm talking about your debt ratio. There's a front end debt ratio and a back end debt ratio. The front end is what is based off of what your existing debts are to your income. Your back end is including the housing. And the housing is the one that, if we include all that, that's typically the one that you can't go above 50%. Again, everything's case by case when it comes to lending, as far as I'm concerned. All right. So here are the things that we would be covering if you were attending the Washington State Housing Finance Commission. And these are things, I give this to you because, again, I do teach that class as long with a lot of other professionals in this industry. And it kind of breaks things down a little bit as far as all the other things that you may want to know. This is going to be a really quick kind of 50,000-foot overview, I guess, if you will, of the different aspects. It's really beneficial, in my opinion, my humble opinion, to attend personally so that you can ask personal questions. Again, these people volunteer their time, including myself and the people that I teach with, and we're more than happy to engage with you at those functions by coming. We don't get paid for that, I guess, if you want to look at it that way. We provide the class, and if you happen to get a loan through us, then I guess we would get paid, right? But I do think that these things are all things that you obviously need to know as you're going through the home buying process. So I just kind of list them all out there, from selecting a program to selecting a home, the different types of programs. I will say this one little caveat, and I do mention this in the classes as well. Each person has a unique situation, and in my humble opinion, it doesn't make sense to necessarily go through all the programs that are in Whatcom County if you're never going to buy in Bellingham. If you're buying in Clark County, then it makes more sense to apply for a mortgage with the person that you feel comfortable with. We would hope it would be our institution, obviously. We'd love to have your business. But whoever that may be, you're going to have to provide all your information. And from there, the lender will be able to tell you which programs you could qualify for. Okay, I just want to mention that. Okay, the home buying process. Let's get started. Here's some of the steps. Steps to home ownership. These are things that we'll be covering. Owning versus renting. Should I buy? I mentioned that with another caveat here is some people, when we run their numbers and their figures and based off of their personal situation, they shouldn't buy. I know it's very rare, and again, as a lender, we should be telling you that you always should be buying. But the reality is that sometimes it doesn't make sense for you to buy. And that's okay, because maybe you have a really good situation with your rent. Maybe you're paying $250 to live in a sweet condo in downtown Portland or downtown Seattle, and the rent will never be raised. Well, then you should take the differential and go invest it. I mean, for simplicity's sake, if you're only paying $250 in rent, So anyway, just something to think about. The players in the home buying process, there are a lot of people. I think I have a graph in here that shows you there's 11 or 12 or 13 people involved. And that's why people are like, well, how come it can take so long? And the reason being is that there's a lot of people to coordinate. Just ask anyone who's ever tried to coordinate a wedding. It doesn't happen very quickly, especially if it's an elaborate wedding. look at your mortgage process as an elaborate wedding, I guess. Okay. Oh, yeah, there's a cool little slide there. The benefits of getting loan pre-qualified and pre-approved before searching for a home. Now, the last few years, that was extremely important. You had to be as good as cash. That's something that I've actually always done in this process because I think it's best to clear everything up front so that you don't have any problems or complications down the road. I mean, at the end of the day, we almost need to be like I don't know what the word is, like a priest, because you have to tell us everything. And by telling us everything, we're going to know a lot about you, and we're going to be able to maneuver the waters if we have to, do anything differently or prepare. Because as we get the documentation in, sometimes it doesn't match up with the story, and that's okay. We just need to figure out what we're going to provide to underwriting so that they in turn can see what we see, and that is getting you qualified for the home that you see fit. Okay? That's why that's important. Other objectives, hang on one sec here. Again, I do apologize. My voice is really bad. That's because we're recording this on a Monday after a Seahawks home game. And if you've ever been to the Clink, it's like a job. We have to yell a lot, especially on third down. Anyway, I digress. Okay. 7 risks that you should consider before buying a home, 5 questions that you should ask and why they matter, and 3 strategies to consider when you budget for a house and compare your financing options. Again, I do really believe that everyone's situation is different, and it's best to be with a lender and a realtor that understand your situation and are going to get you in the right property that fits your family's needs. Okay, so the steps to home ownership. You've got to factor in education, credit history, obviously education, this is part of the thing that you're doing now. A budget, I know people hate that word, but being a former financial advisor, I do think that budgets are key. Believe me, I've overspent and blown budgets a bazillion times in my lifetime, in my career. We can't help it. We're human beings. We like to spend money, but you kind of got to get that under control before you start buying. Research, obviously, there's a lot of things to do out there for researching homes. I provided a little, I don't know, where's the camera? There it is. If you look down below right there, I've got Home Scout. That is an amazing app. We'll give you that tool at the end of this thing for free. It searches properties, I believe, better than any other tool out there. If you're using Zillow, we all know, ask any agent what garbage that can be. It's highly inaccurate, because the thing you got to think about is all those other companies are marketing companies. They're not real estate companies. They're just there to collect your information and sell it. So anyway, researching the properties, loan pre-approval. Again, we talked about that before. We want to get you fully approved, not just, you can go onto the Rocket or any of these other companies and click on a bunch of buttons and they'll issue you pre-approval. Now, here's the thing I would ask you. How valid is that? Have they validated any of your information? I mean, really, if it's as simple as that, again, here's the thing. Can that be done? Sure. Are you an 820 FICO, which is a credit scoring mechanism that lenders use, and you're putting 20 or 25% down? All your income is not from self-employed sources. You're straight W-2'd. You fill out a 1040 EZ, basically. You've been at the same job for 10 years. No overtime, no bonus, no commissions, none of that stuff. If that's you, you probably don't need someone like me or anyone else. You can just click on those buttons in the Rocket or the whatever the latest and greatest technology piece is. You can probably get along. But I would say about 85% of you are going to need a professional to look through your stuff and get you validated and tell your story. So anyway, there's my little pitch there. Again, Home Scout is a great thing, and then your home, which is part of the real estate piece that I'll let the realtor cover. So here's just a quick example of Home Scout. It just is a really great tool. You can use it online. You can use it on your phone with the app. It's got great pictures and statistics. It also can search by school district, which I know a lot of the agencies can't even do. They've got to do a 2-step process to do that. So, and they're always updating things. And here's the most important thing actually about this tool and why I love it. You can use it all across the country and no one's going to bother you. Your information's not going to get sold, and you're just not going to be bothered. And it's highly accurate, obviously, because it's direct link to the multiple listing in all 50 states. So, okay, so let's move on. So to me, that's the unfair advantage for home buying. We've used it for buying investment properties and flips as well. So why should I buy instead of rent? Well, let's face it, a home is an investment. When you rent, you're writing a monthly check that's gone forever. You're paying someone else's mortgage, right? That's the reality. And you can keep doing that. All you've got to do is look at, well, how much did I pay in rent the last 2 years? If you paid $2,000 a month, that's $48,000. And what do you have to show for that? Now, you got a place to live, sure, but you have no equity. You have nothing. And you didn't get the tax benefit. Now, the tax benefits aren't as big as they used to be, but you still have a little bit there. You get the property taxes as well. When you own a home, it's funny. I must have done this a few times. You still get the tax deductions associated with paying your mortgage and the taxes and the closing costs. So when you close, you'll get your mortgage statement, and you can take that to your CPA, and they'll tell you what you can write off. But you won't be able to get that. Also, unlike rent, and we indicated this, you have equity. The value of your home could go up. So if you bought a home, again, let's use Clark County, for instance. I'm recording this in the year 2018, and I know a few people that one of you may even be on this call. I won't name you. But we were talking about buying a home 2 years ago. And 2 years ago, you could have bought that same home for about 180,000, I think, if I'm right. What's that house worth today in 2018? More than 180,000. Now, your mortgage payment might have been $100 or $200 higher than what you were paying in rent. But again, how much would you have in equity today? Those are the things that you need to think about when you're making a decision and buying. All right. Finally, you'll enjoy having something that's all yours. That's the less numbers driven thing. Obviously, it's your own personal style. You can tell the world who you are and how you want to decorate it, and you don't have to rely on a landlord to fix things. You get to fix things. So that's why I do believe in some liquidity as well. That's why when we go through this process with your lender, sometimes it makes sense. Again, not always at all. And it's never a this or that. It's sometimes it makes sense to not put all your money down. And maybe if you qualify for a grant, take the grant money, because then you'll be able to buy furniture and you'll be able to have a nest egg, at least some type of savings, because things always go wrong in a home. Let's just face it, the gutters, the windows, the AC, the heating, whatever. There's always something. And now you can't call a landlord. So I guess that might be the negative, right? If we're being real. Okay. Who are the players in the home buying process? Who are they and what role do they play? Now, there are a lot of people involved in getting this transaction done for you. Hang on one sec. And I will, here's some of the people that are involved. You've got a buyer's agent typically. You've got a seller, obviously. And then you got someone representing the seller. That'd be the seller's agent. You got a mortgage professional or a loan officer, or you got a computer because you're the part of that, 5% that doesn't have any fluctuation in income, and you can just input a bunch of buttons and get a real quote, and they'll validate all your information instantaneously. Then you've got that. Then otherwise, for most of you, you've got an underwriter. An underwriter is the one that's going to determine whether you can be approved for the loan or not. Then there's also an appraiser. Now, the funny thing about appraisers too, and I love appraisers, by the way, because they have one of the hardest jobs. Their name's the one that's on the line on the value of that property. But you have to pay for your inspections, typically out of pocket up front, and your appraisers almost always get paid as well. I don't know of any lenders that will order an appraisal without you giving them a credit card, and the reason being is once the order is placed, again, this is 98% of the time, the appraiser gets paid on that deal once that order is hit. So you've got to pay for it, because if you cancel, that's just how it goes. There's an inspection that's typically done before the appraisal as well, and you'll pay out of pocket for that. That can be, $2, $3, $4, $500, depending on if you want infrared and heat sensors, and, all kinds of things, and obviously the square footage of the house and the age and all that. In some states, where again we are licensed in multiple states, so we try to cover it all, you will have an attorney. And some of you may choose to use an attorney. It's just an extra cost. In the state of Washington, you don't have to worry about that as much. Otherwise, you will use an escrow agent. So you have title and escrow. So title's the other one. You have a title officer, because they got to make sure you don't owe the IRS $20 million and you got a massive tax lien, or there's things on the title. This is designed to all protect consumers as well as sellers as well as lenders. We've got to have title insurance for those things. Homeowners insurance, it's pretty mandatory that you have homeowners insurance. And so one of the things that you want to do with your lenders, you want to make sure to get them the information on who you have. I would not wait till the last minute to decide on who you're going to have for homeowners insurance, because you can call a few of those and get quotes right away. If you have a really good lender, they will typically have a couple insurance agents in mind, or a couple options for you as well they can put you in touch with, and get some quotes, or at least get a binder done. You can always switch that stuff after closing, obviously. No one's binding you to it. But again, you have to have homeowners insurance up front. And then sometimes maybe a mover's involved, because you have to hire movers. I can't remember the last time I didn't hire a mover. I'm just too old now to do that. Okay, let's keep it moving. Pre-approval. Again, we alluded to this a little earlier. What is the difference between pre-approval and pre-qualifying? What is important? Why is it important to get pre-approved before you shop for a home? And then what's a loan estimate? It's one of the new disclosures. Back in the day, we used to have a good faith estimate, truth in lending, and then we had what I loved was a HUD settlement statement. We don't do those anymore, which kind of sucks, I think. That's one of the things I don't like about some of the new laws. The old HUD settlement statement was just so much easier to read. Okay, so I've given you a page of, this is just a generic, this is not real, so hopefully DFI is not going to make me go through it here, but this is basically a sample, fictitious bank, fictitious client, loan estimate, page 1. And you can see it gives you a lot of information as far as, what kind of a loan you have, the term. Is it a fixed rate? Is it a, adjustable rate? Where's the property address? What's the sale price? What's the loan amount? What the monthly principal and interest payment? Can this amount increase after closing? If it said yes, it's because you have something other than a 30-year fixed. Down below, you can see in the projected payments, it tells you years 1 through 7, it's going to look like this. And this is more likely a client that isn't, putting 20% down because they have mortgage insurance in there. We'll go through that at some point as well. Typically on your taxes and insurance, they include that in the payment. It's called escrow. Now, there are some instances where you don't have to have that, but typically, again, not always, but typically a lender will charge you for that because they like to escrow your account. You look at the bottom on this, and it's going to show you what your estimated closing costs are. And it kind of breaks that out, and then it tells you what is the cash to close. Again, we knew by looking at it that they weren't putting 20% down, so we knew there was mortgage insurance, and so we knew there would be at least some kind of a down payment. And in this case, it looks like they're buying a property for $180,000, and they get to come in with about $16,000, and their loan amount is $162,000. So anyway, there's that. Let's see if I have page 2 here. Oh, good, I do. So page 2 kind of breaks down the costs as well. I'm not going to go through this line by line because that's something that you would typically go through with your lender, but I'll put it up there for you. It breaks things down into the cost to the lender, costs that you cannot shop for, and that's typically going to be things like the appraisal fee, a credit report. Yes, you do get charged for a credit report, whether they tell you or not, because there is a cost for everything in this world, it seems, right? So you've got that. You've got flood determination. They always have to make sure you're not in a flood zone. Otherwise, you can have pretty expensive insurance, too, sometimes not so expensive if you're in a low gradient for a flood zone. There's inspection fees of all kinds, and those are services that you can shop for, I guess. They say that, but at the end of the day, usually the seller or the buyer are going to dictate who title and escrow is. So you can make a stink about that, I guess, but they're all roughly the same. We do have some title and escrow companies that we like to work with because they know how to close loans and close them well. But again, those are just some of the variations in fees. You've got taxes like recording fees. Believe it or not, they've got to record your trust deeds and the things that indicate that you own the home, or I guess the bank owns the home until you pay them off. You will have to pay prepaids is another one that sometimes people forget about. Depending on the time of the month that you close, they're going to collect interest from that day till the end of that month. And then typically you're going to have your first mortgage payment 30 days after that as well. And then there's your escrow account. So, there's that. Okay, I'm going to move it along here. I'm running up on the 25-minute mark, and I want to try to get this done for you. Page 3, again, is from Fictitious Bank here, is going to kind of give you some comparisons of what the annual percentage rate is. And this is let's see if I can move myself so you can read that a little better. Let's see. Yeah, I'm in the corner now. The annual percentage rate is your cost over the loan term expressed as a rate. This is not your actual note rate. The annual percentage rate is typically higher because they have to take into account your interest rate plus all the fees. And so when they calculate that out, it's always going to be a little bit higher. I think if you noticed on the previous page, let's see if I go back here. The interest rate that this person was charged was 3.875, right there in the middle to top part. But on their APR, it was 4.274, and that's very, very common. Okay, next page. So, does anyone need a bathroom break? Just kidding. I'm just going to keep going. How much can you afford? What the bank is looking at is what, again, we call your debt to income ratio. The 3 C's: credit, capacity, and collateral. And your down payment, obviously. So they're going to look at your credit score. Does it matter? Yes. In my opinion, my humble opinion, credit doesn't matter as much as you want it to matter. What matters really, is the capacity that you pay the loan back, because you got to have income. You got to have the ability to pay that back, and we got to be able to predict what your income is. I've had clients from where they're making, 10 million one year, and the next year they make nothing. And then they make another 8 million. Then they make 0. Then they make 2 million. Well, that's going to be a lot harder than someone who is a professor at the University of Washington. They get a base salary of 180,000 and there's no bonuses or commissions, but I can take 180 and divide by 12 and just get a number. That's more predictable. Now, I'm not saying that person's any better than the person making, 10 million or anything. I'm just using it as an example of some of the things that we look at for that. And again, these are things that you want to get in with your lender as far as, what that's going to look like with your situation. So how much can you afford? Remember, we alluded at the very beginning to debt ratio. And so we're going to take your gross monthly income and we're going to multiply it by some maximum number or some ratio. So let's say on a particular program, the maximum debt ratio is 45%. Well, that means if you make $3,000 in gross monthly income, not your net, so not your take home, I want to see your gross, where you paid out before they take out all the taxes. That means you can't have all your expenditures exceed $1,350. So what that does mean is, let's say you got a car payment and some other credit cards and maybe child support, maybe a student loan payment, whatever. And that total is $400. Well, I'm going to take $400 from that $1,350 because $1,350 is our cap. That's the max on this program. And now you're left with $950. Well, now we have to work backwards, right? That's going to take some finagling because taxes and insurance are going to vary from property to property more than likely. And we got to figure out what is the maximum principal, interest, taxes, and insurance you can afford. And oh, by the way, if you're putting less than 20% down, now we got to also figure in mortgage insurance. That's why sometimes, you hear people say, oh, I should wait till I get 20%. Again, I don't know. Everyone's situation is different. That can work for a lot of people, and it's been really good advice. I'm not saying that you shouldn't do that. But again, where would you be if you bought a home 2-3 years ago at $180,000 and now the home is worth $350,000 or $400,000? I'm not saying it could be. I'm just saying as an example. would you have been able to save 20% by then? Or could you have just gotten in, made the payments, and now you have all this equity? Just saying. Something to think about. Again, every person's situation is different. Okay. So again, how much can you afford? We took the principal, interest, the hazard insurance, real estate taxes, the mortgage insurance. So we did add it here. If you're buying a condo, typically you got homeowners association dues. If you're taking out a second mortgage, that's another topic and one to discuss with your lender. That would be subordinate financing. If there's a payment associated with that, you'd have to take into account that as well. Okay. To calculate total payment to income ratio, take your monthly housing debt and divide by your monthly income, which we just worked backwards, right? So that's that front end and back end ratio that I was talking about. 950 divided by 3,000 is 31%. But again, if we add in the 400 that we had in all the other debt, your debt ratio would be 45, right? You guys can figure that piece out. Oh, so there's the slide. I guess I'm getting ahead of myself. So that's where that slide comes from. I'll whiz through that now. So how much cash will you need? Well, you've got the down payment, percentage of the value of the house. Most programs, most typical first-time buyer programs are 3% down. FHA, which is a common one, is 3.5% down. And then, there's 5%, 10%. All have different gradients and variations as far as what the rates will be. Some provide some really good rates if you are a first-time buyer and you make less than a certain median income. That's where a lot of the grant programs come into play too. Again, it's best to provide all the realistic information to your lenders, and they can walk you through, hey, you could qualify for this grant, or if we could put 5% down instead of 3% down, I could get you a rate that's this much better. You see what I'm saying? There's just so many different programs. And then are we doing a fixed? We could do an adjustable, and that would be a percentage point less. So then we could qualify for more home, or we could get a lower payment. There's just so many variations and things to think about. Okay, private mortgage insurance. That again is pretty much added on there if you have anything less than 20% down. That's almost mandatory on our programs. There is something, I don't know if I want to talk about it right now. There's a thing called lender paid mortgage insurance, and that basically is where they don't charge you a monthly allocation. They add it in to the interest rate. Okay. Then you got closing costs. Obviously, that's in addition to down payment. You're going to have closing costs associated with the loan. That's things like the appraisal and maybe origination fees, title, escrow, prepaids. Prepaids are the things that are attached to the property. That's going to be like your taxes, insurance, things like that. Okay. Objectives. Here's one thing that I'll try to cover this pretty quickly here. We're coming up on about the 33 minute mark. And this is just things that I like people to think about because, again, the easy question always with buying a home is what? What's the interest rate? What's the interest rate? And again, I'm not saying you can't use that as a determination for whether you should buy or not. I just think that there are way more other factors that are more important than what the rate is, because the rates are going to go up and down on a daily, weekly, monthly basis. And what you need to decide is, what are some risks you should consider before buying your home? There are other questions that you ask yourself and why they matter. And what's the best situation for you and your family? That's really what it comes down to. So let's dive into that real quick. So again, here are some of the things that I have learned from many other people that are much wiser than me. But here's some of the wrong questions, in my opinion. What's the interest rate? And what are the closing costs? Okay. The thing is, risk is really what you should be considering. Housing prices go up and down all the time. There are costs of the sale of the property. So even though you might make a bunch of equity in the property, by the time you go to sell that house, are you going to break even on that? The other thing you got to think about is what would you have been paying in rent that whole time? There's going to be maintenance costs on the property, and some property are going to have less maintenance costs than others. Some would argue that condos can be more risky, and hence some lenders will price those a little higher as well. There are other opportunity costs. Again, let's talk about the situation I talked about in the very beginning. Some people, it may not make sense for them to rent because maybe they're getting such a good deal on rent. Their opportunity cost of going and buying something, they could take that amount of money and go put it in the market or go invest in their own business or whatever it is and make a way better rate of return than in a property. Okay. Lack of liquidity. That's another thing you need to consider. Again, if we put everything down to keep, we're scraping by to get 20% down to get in this property just so we can avoid the mortgage insurance. But now that you've got all the money in the house, you have no savings, you have nothing to fall back on. What if something goes wrong? How are you going to get the money out? Because that's the one thing I have seen as people age is they become house rich but cash poor. That's a tough spot to be in sometimes. That could be a forced sale. So that's, again, these are just things to think about, people. Long-term commitment and changing cash flow needs, kind of along the same lines, but where do you want to be? Is this a property you're going to buy for 1 or 2 years and get out, and because you're going to move, or you're going to, your family life situation? Maybe there's two of you come together and you're going to both sell and buy one property, and one moves in with the other. These are all things that you really got to consider. I think that are so much more important than what's the interest rate, because that's obviously the number one question that we get. All right. So here are some of the right questions. What am I really trying to accomplish with my housing situation? I think we've alluded to that in different ways. Like, what is the best program and down payment option or lack of down payment option that fits your family's situation? Why is it better to buy a home right now versus renting a home? You can argue that some people that bought homes in the last 2 or 3 years are paying, top dollar. Maybe now is a better time to buy. There could be advantages to either situation. Again, depending on what your short-term and long-term goals are. And how can I make sure this fits into my budget? Again, I've done this a few times, so I'm kind of alluding to the next thing here. What's your short-term and long-term budgetary needs? Let me move myself here because I'm blocking. Put myself over on the left. How about that? How will this financial decision impact other areas of my life? Marriage goals, children's college funding, retirement, taking care of elderly payments. If you have a special needs child, special needs friend, special needs any situation, that can be, daunting as far as time, energy, effort, and money. So you've got to think about what's going to be the best situation for you. So anyway, that's, again, just something to think about. And what mortgage and home buying strategy will result in less overall financial risk? Those are some of the things that we like to throw out there and have conversations with our clients about. There are people that, want to buy a lot of rental properties, and once we help them get into their property, they can start accumulating equity and start taking money out, and they start buying homes, and they are either fixing and flipping, or they're doing long-term strategies where they're buying and holding. Those are all different things and different strategies. And again, some of the things that we do, being a certified mortgage planner as well, is, we like to look at, what's the buy versus rent. We've got all these different calculators we can run for you, and I'm sure you can find some online as well, but it's nice to kind of put in your situation and just see what that looks like. So that's one thing that we do. We do have debt planning calculators. I'm big on, again, just making sure that everything's fitting within your budget. I hate that word, but really there's no other word that describes what you got to do. You've got to kind of buckle down sometimes. Sometimes it makes sense to have the seller pay your closing costs. I would almost argue that it almost always makes sense to do that because you're better off with the liquidity. But again, there are a lot of people, different school of thought, that say, nah, I'd rather just pay it out of pocket. And that's okay too. I'm never going to tell anybody they can never pay full cash for a home. But I would argue, and many financial advisors would argue, that your home doesn't care whether you owe $1 on it or it's maxed out. It's going to appreciate at the same rate of return. It's what you do with that differential that matters. So again, something to think about. And we obviously are, always looking at what mortgage bonds are doing and the guide to the housing and interest rate markets. There's so much information out there on this stuff. You can Google all this. We have sources for you as well. We could recommend. It's difficult to predict interest rates. We do, because if we could, obviously we probably all make a lot more money. But we just know that they go up and down. And here's the thing you got to think about. We've had really good interest rates for 13 plus years, and they've just started going up this summer. This is 2018 that I'm talking about now. And that's just how it is. It's always up and down, when there's certain things in the economy that will dictate, what's going to happen out there. And, anyway, I try not to get into that debate with people. So, again, I want to thank you guys for tuning in. Hopefully we gave you some pretty good information. I tried to keep it right around 45 minutes. I'm running up on the 40-minute mark. So in conclusion, those are some of the risks and some of the questions and other strategies to think about when buying a home. Again, my name is Joe Jonart. I'm with the Builder Affinity team at Bank 34. And we'd love to be a resource for you. We'd love to help you and help you get into a property. But again, it has to make sense. Typically, we have you apply with us. We have an online link that'll come right into our system. We'll contact you, start collecting documentation. My assistant will typically schedule an appointment, either a phone or a Zoom interview, and we just go from there. So happy house hunting. Home Scout. Okay, so let me give you this. I'll try to go back to that slide. But with Home Scout, if you go to homescout.com or if you go and look for the app on there, the VIP code that you will need is just my phone number, 206-910-2247. For those of you that are tuning in, we appreciate that. And if your realtor recommended you to us, please shoot us an email and let us know. We'd love to thank them for that referral. And again, thank you for tuning in, and hope you have a great day, and hope that we get to meet you soon. So here's in final conclusion too. Get pre-approved, versus just a standard pre-approval. I think that's the best way to go. If you haven't done that yet, you got to do that first, because I know you think your situation's perfect and everything's okay, but at the end of the day, why don't we just find out? It doesn't hurt. Why don't we just find out? Let's just go through the steps and let's get it done. I'm a big fan of that. And then once you know the number, you got to give yourself a little variation. Then you meet with your real estate professional. You obviously can search through Home Scout and try to find the property, and then it becomes a much easier buying experience. The previous tag, by the way, is something that we do at the Housing Finance Commission. I'm a fan of that. If you ever have problems, or if you know anybody that's got problems with their mortgage or they can't make their payments, just give them this information. There's all these home ownership hotlines that can help them get out of trouble if they're missing payments or they've gotten into some trouble or something. Okay. And again, thank you for tuning in. Again, my name is Joe Jonart. You can email me at joe.j@bank34.com or 206-910-2247. Have a great day. Bye now.